Jump right into the questions. I'd open this up to everybody. You know, the past year certainly brought a significant degree of evolution, broadening market acceptance for the marketplace or tech-enabled lending sector. What, in your view, has been the most important development over the last year?
Who wants to start?
Do you want to go first?
I'll jump into
Go
it.
for it.
I think probably every single one of the major originators developing their own shelves to become issuers of their own securitizations and becoming active issuers. You know, we've seen deal structures get standardized. We've seen all the deal parties become standardized, and just communicating, you know, consistency around timing and volumes to the investor base. And I think that's driven in spreads a ton. And then I'd say also towards the later part of the year, a few of the major guys also getting trust certificate programs off the ground, and that will be a big theme going forward.
Yeah, and I would just add the focus on diversification of the investors in the space, and it all kind of flows together with respect to what Perry was mentioning in terms of, you know, having their own sponsored shelves. I think that that's been very helpful, where, you know, investors know what they're looking at. If it's a you know, club prime or near prime deal, they'll have an understanding of what that means, and it's helped to bring more investors in the space. And also, I would say, you know, there's been more focus on controls and disciplined underwriting, which, you know, you'll tend to hear me talk about over and over again whenever I'm on a panel, because I think that's very important in terms of, you know, not, you know, any consumer sector, but certainly in terms of the marketplace sector.
Yeah, adding to that, I mean, the space continues to evolve. For us specifically, securitization was what we're a big deal, doing self-sponsored securitization for a couple of reasons. One was, you know, there are a number of investors who had been looking at the space but needed us to hold risk retention for them to get comfortable. So us doing self-sponsored securitizations was a critical step in bringing a new set of investors onto the platform. In addition to that, you know, as Perry mentioned, we launched something called a Club Cert. Club Cert is a QSIP tradable vehicle, which allows, it's a pass-through security, which allows investors to, again, not buy whole loans, but buy exposure of, you know, not a tranche exposure, but a full exposure to the loan, but in a tradable liquid way, which is again brought a whole new set of investors for us. So the way I see it is the evolution continues. More structures will drive broader acceptance, and whether it's insurance money or other money come into the space, which has till now been watching, learning. I think now you're going to see greater and greater participation in the space.
Yeah, and we've seen the asset class go mainstream over the last year or so, and all deals are now rated. Kelley is here, she can talk more about it. And that's, with rating agencies getting more comfortable, you have more broader investor participation. We expect to see the growth in issuance continue. We expect about $18 billion in issuance this year to take the total to about 50 since inception in 2013.
I'm not sure this is really a development, so to speak, but I think that over the last 12 months, the recognition by all players in the sector, investors, issuers, equity holders, outsiders looking in, that at the end of the day, we are lending and we're extending credit and making sure that we get the money back, we earn a decent return, and focus on the financial aspects of lending are paramount and our number one priority. And I think that's really come home and established itself across the board as being the one thing that we should be aiming at first. And that's been a focus for Marlette since inception. And we're proud to deliver those returns to investors and for ourselves. And we see a lot of good things happening in the industry as that focus continues to refine itself.
Great. Maybe I'd direct this one to Perry and Ashish, but you talked about it a little bit in the opening remark, but how do you think about the availability of better data and qualitative tools affecting the market, and what are you hearing from investors about, their largest outstanding wants and needs for the sector?
So I think the data has played a huge part. If you look at how these guys have operated and the transparency being one of the core values and just making the whole performance data set available to investors, it's really allowed people to get extremely comfortable. It's also just removed a lot of barriers to entry. You look at some of the more traditional ABS markets, and if you think about, mortgages is my background, so that's what I always use as a proxy, but what it takes to get, the same kind of setup that you have here, buying data sets, buying databases to house those data sets, paying for, cash flow modeling. It's like $1 million build out just with vendors before you even get into all the stuff that you have to do internally. And companies like DV01, PureIQ, and so forth, how we've kind of streamlined that process, how we've also changed the business model in a way where, a lot of the issuers are signed up to having us as a loan data agent, getting that paid out of the deal, and just making it way more open and available. And I think, you see the benefits of that with just the diversified investor base and the, having such oversubscribed deals constantly. So I think that's a huge thing.
Yeah, like Perry said, we are approaching standardization of data in the space, but we're still not there. We need third parties like DV01, PureIQ to actually bring all the platforms together to make the data comparable across platforms. And that's a big development for investors looking to invest in this space. They can finally get their hands on data that they understand. What we also see is that a big question our clients ask us is, what is the performance history for this asset class through the crisis? And this is a relatively new asset class, so there isn't much through the cycle data here to say what's going to happen through a crisis or through a downturn. And I think here you need to look at some alternative data sets like the ones we have with our partnership and investment in TransUnion, that you can look at consumer data for different assets through the cycle to see what kind of performance you can expect on this asset class given the relative short history that we have here. So these are some of the data issues that I think, while being addressed, would help make the asset class evolve a lot quickly.
Great.
Yeah, sorry, just to jump in on one small point, I would say that I don't view it as its own asset class. I think it's just a segment of the consumer loan, or depending on what it is. We're talking about consumer loans primarily here, but a segment of that space. So we look at it more as a segment than its own asset class. And I think, to Ashish's point, it is important to look at other types of consumer credit in terms of how they fared throughout the cycle, but then also look specific to the risks, the additional risks of marketplace in terms of looking at potential stresses in a downturn. So,
anyone who spent the last 3 days here, I think, feels how bullish financial markets broadly feel. And I think most participants would view tax reform as kind of a positive for the average consumer borrower. But there's certainly increased focus around credit and the health of the consumer given where we are in the cycle. Maybe I'll start this one with Sid, but what trends are you currently seeing, in the data, and how does it affect your outlook on the space?
Great question. When I think about the consumer, at the end of the day, consumer indicators are all very strong, right? So you have growth in terms of jobs, you have growth in terms of wages, unemployment is at all-time lows, housing has remained fairly strong, supply is tight. So all the macro indicators as far as the consumer is concerned are pretty strong. At the same time, what we've seen is a shift in the debt cycle. I talk about this a lot. 2009 to 2014, credit was very tight for the average consumer. For people who had high incomes or had a lot of assets, that was not a problem, but for everybody else, credit was fairly tight. What we've seen is 2015, 2016, markets opened up, banks started to lend again. A lot of tech-enabled lending also caused certain asset classes to open up. So what we're seeing is the supply of credit has led to a total increase in credit. Every day or every month I see new stats from the Fed and other sources that show mortgages, total mortgage debt is close to being back to 06, 07 levels, or credit card debt is up to $1 trillion. So when you look at these numbers, while it's supported by a higher income base than it was in 06, 07, what you are seeing is you're seeing a shift in the debt cycle, and that causes shift in performance. So we saw below normal delinquencies and loss rates of 2012, 2013. Starting 2015, 2016, we've seen a normalization of credit across asset classes. Banks are seeing it, credit card lenders, auto lenders, everyone's seeing that. So we've continued to watch that, and we've adapted to it. So every quarter, we publicly talk about what credit performance has been on our platform and the key insights and what that has led us to do in terms of adapting and tightening credit to make sure we're staying on top of the risk-return opportunities. One of the key insights was, how did the consumers who didn't have access to credit when supply became available, how did they react to it? The borrowers who ramped up debt quickly in a period of 6 to 12 months are the ones who are now feeling stressed because they didn't have the discipline or the habit of how to manage that debt. They took on the debt because it was available to them, even if their DTI levels are within our threshold. So one of the indicators that we focused on beyond just total indebtedness is the velocity of debt. How quickly did the borrower take on debt? And to make sure that we're managing risk appropriately for those borrowers.
Like you said, Sid, we've seen some of the highest levels of consumer debt in the last year or so. But per capita debt is still nowhere close to its peak. So that's, I think that's a good sign. But I think the balance is shifting from the lender to the consumer. We're seeing a lot of competition, especially on the supply side. We have platforms like Goldman Sachs Marcus coming into the picture. There is a lot of competition for the marginal customer. It remains to be seen how this evolves. We would hope that competition does not push risk pricing to a point where platforms can't make any money.
Okay.
So it's Goldman's fault.
I actually don't see that
Not
as a
for the
negative.
borrowers.
I actually don't see that as a negative. I see the entry of Goldman and even Citi's announcement more recently as a positive. It's a validation of both the product, the benefit to the end consumer, and the fact that there is economics to be had. Yes, you're talking about lower cost of capital players enter the market, so the others existing in the market have to adapt, including us. And we have banks on our platform that buy our highest quality paper, the paper that Goldman or Citi or others would issue. So we have the low cost of capital players providing the funding on the platform that are competing for the similar kind of credit. But the very fact that you have larger banks step into a space is validation of an asset class that otherwise, if you just had smaller tech-enabled players, this I look at that as sort of more of a proof point that this works.
We appreciate that. So, there's been tremendous spread compression across structured products over the last year, and certainly, the tech-enabled lending space has benefited from that. But it still remains relatively cheap compared to, more commoditized asset classes. So maybe I'll start this one with Karan, but where do you see spreads headed in 2018? What are you hearing around kind of your engagement with investors, and do you expect there to be more tiering across, either asset types or maybe more relevantly for you guys, different issuers?
Yeah, it's a great question. I mean, 2017 was quite a journey for most of the platforms. We started off our first deal in 2017, had an average credit spread over swaps of 240. 12 months later, we did a deal in January, 240 had gone to 87. So massive spread compression. So there's probably still a little bit of room to run there, but I think that's validation of what we've been marketing all along, and to a great extent is reflective, obviously, of market conditions, but when it comes to specific names of investors recognizing the benefits of good performance, and that this is, this asset class, I'm not sure if that's the right word, that this product is now mainstream or emerging from being an esoteric alternative investment into one of the more mainstream asset classes that's going to have wider acceptance, more liquidity. It's going to be more broadly accepted by credit committees, and generally speaking, a part of investment managers' portfolios across the board. And so we've always endeavored to have more new names in our order books. And with every transaction, we've probably brought in 3, 4, 5 new names. And over the course of half a dozen transactions, we're now at 2 dozen, 3 dozen names, but there's still room to go. There are a lot of investors we meet at this conference, for example, who ask us, what is this product about? Who ask us, what exactly do you do? How are you different from somebody else? So the education process is still ongoing. And that's never going to be complete, but as that starts to develop over the course of 18, I think that, maybe there's another 20 bips to run on spread compression. Frankly, that would be a very, very good outcome. I'd be very happy if my spreads are at 60 at the end of the year. But that's, it's been very positive all along.
The way I see it, the benchmark indices have gone up. Spreads have come down and the yields have remained the same. And the reason for that is for an asset of the duration that you're talking about it here, the whole loans themselves have a duration of 1.5 years. For 1.5 years duration, getting a 5.5%, 6% return, there aren't too many other alternatives where you can find that. You can get a 5.5%, 6% yield, but you have to go much further out in duration to get it. So for people who've done their homework, who've done their diligence, who understood the underwriting, who are looking at the asset class, this has been a pretty compelling opportunity. And as securitization has picked up in the space with self-sponsored securitization, risk retention by the issuers themselves, I think the acceptance of that has led to the greater demand and yields being where they are. Now, at some point in time, as benchmark indices keep going up, that disconnect of spreads compressing will, that'll break. At some point in time, spreads will widen. But to the earlier point, I don't think it's immediate, right? That may happen some point in time down the road. Right now, the market's pretty strong just because it's a pretty compelling value proposition.
Another small point I'd like to make is the asset class still is only about $30-odd billion in issuance. It's really a fraction of the securitized product market. And you also have, like Sid mentioned, this duration-adjusted yield aspect of it. And in a rising rate environment, being on the shorter end of the curve is obviously going to be more beneficial. I would expect you to continue to see some spread tightening here.
Rosemary, maybe we'll turn to you. Kroll's been an early leader in engaging in marketplace or tech-enabled or whatever we want to call the sector. How have Kroll's views of this space evolved, and what does this imply for your ratings outlook, both near and maybe longer term?
Yeah, great. We have done a lot of work in the space over time. We did a lot of work before actually even putting any ratings out with respect to marketplace transactions. And I would say that, initially we looked at it and, we had, we were conservative in terms of our approach due to some of the specific risks associated with the space of, many of the platforms had less performance data than a full loss cycle, fast-growing, intranet-based lending, and having operated primarily in a relatively benign credit environment. So we've been conservative in terms of both, looking at it in terms of A, can we rate a transaction, and B, at what level, and what's the coverage needed for investors. And as we have seen, the platforms, as there's been more data over time, just with, time going by, as we've rated more transactions in the space, we've been able to get more comfortable as certain platforms in particular have, proven out relatively stable performance over time, the willingness to pull back where needed in terms of different credit segments where they've seen consumers potentially, getting over-levered. And then we've been able to move up the rating scale with respect to specific issuers, and I'm sorry, Sid, but Karan, for Marlette, we've actually been able to move up to AA, and been able to get more comfortable with time. And we would expect that to continue in terms of seeing that stable performance and having more comfort with respect to being able to project losses, the controls in place, both on the underwriting side and the servicing side. So that would be what I expect to see is sort of the natural progression with respect to to ratings, but it has to prove out first. I think that, we're going to continue to be conservative, just looking at what's going on with the consumer itself in terms of those overall debt levels, in terms of the competition in the space. I agree that it's a positive thing in terms of this sector, but, more competition means that, people really have to focus and make sure that they're being disciplined with respect to the loans that they're underwriting, and that we need to be able to see that over time.
So more and higher ratings. Is that what we take away from it?
If things play out as we would hope.
So, clearly we've made big strides in terms of investor acceptance, rating, spreads, but maybe turning a little bit to what's to come. Open this up to everybody, but would be curious to get the panel's views on what do they believe are the most significant structural evolutions that have occurred in the sector, and how much change should investors expect near term? I don't know if Sid or Karan want to start.
Sure, I'll take a stab at it. So I talked about sort of the move towards risk retention. So for us specifically, moving from a pure marketplace to more of a hybrid where we hold some of the risk while we continue to distribute the asset to our investors. So I think that's been an evolution of the space, which I think is positive in general for the industry. Securitization clearly has helped bring in new investors who may not have had the appetite to buy whole loans themselves, but can now participate through A or B bonds. And then as they learn and get comfortable with the asset class, then further decide what their risk appetite is. In terms of structures, we rolled out the Club Cert, which is a QSIP pass-through security, which is positive. I look at the next year and a half. At some point in time, we're going to see revolver structures come in, which I think is just a more efficient structure from a cost perspective. So I look to see the space continue to evolve with both the structures, the investment structures evolve, but also the participants and how they participate evolve as well.
Yeah, like you said, Sid, the club structure is a great innovation forward, and we're also seeing exchange-traded products being talked about. We're seeing 40 Act funds trying to get daily liquidity to retail investors. That's some of the things to look forward to.
Karan, any more?
Sure. I think that there's going to be innovation all around from the structuring perspective. I think some of it's going to be visible to external ABS investors, and some of it's going to be on the platform side, and some of it will be on the whole loan delivery side. We're already sort of seeing the aggregation of loans at the platform level, and then the delivery on a periodic basis. The club certificates, for example, is one mechanism by which you can do that. Marlette has been balance sheeting loans for several years now, and we're also evolving to structures where we are moving away from some of the operational headaches of daily loan delivery into periodic loan delivery, and that has benefits on both sides. It takes away a lot of the noise that comes from onesie twosie loans that are rescinded or canceled, and makes it a much more seamless process for the end investor. Also opens up the investor base to others who don't have that kind of operational overhead, operational capability to buy individual loans. I think we're going to see developments on the risk retention side. Those structures are very, very basic at the moment. And looking down the road, I think potentially we're going to see the breakout of IOs and POs, possibly, where some of the prepayment risk is like the mortgages from pre-crisis days, where the prepayment risk is being separated out, and somebody's able to buy that. Because we do hear often from investors that concerns around prepayments and the uncertainty around prepayment speeds is definitely something that's high on their minds.
I think one thing just worth pointing out is just how, innovative for structured finance all these issuers, originators are. It's a far cry from the very generic, just like originate to securitize and you just do this deal every quarter and, every structure looks the same. Maybe much to the detriment of Karan's social life, but these guys are actively hustling and, putting forward different structures, very investor friendly in general. and just looking for different ways to move the product. And I think ultimately that enhances the liquidity for everyone, whether or not you own Marlette loans or Lending Club loans, or you own a club certificate or a securitization. It's just good that, you know, there's a lot more people familiar with that product. And, you know, the originations are consistent across all these channels, so it's always easy to back into kind of, you know, what you think performance should be once you get past the structural components of it all. But it's all pretty simple structures too, so.
Yep. One of the things I think we'll continue to see more of an evolution around is the secondary market, right? So historically, there wasn't much of a secondary market. People were buying whole loans and holding it onto the balance sheet for longer periods of times. But with the new structures we're talking about, we're seeing more secondary trades happen, more liquidity come into the market for people who want to exit existing positions. So I think that's pretty healthy. And the more the segment matures, the more you will see secondary trades happen.
So, Karan, you touched on it a bit in your remarks, but a year ago at this conference, there was a lot of focus on, you know, risk retention rules and the effects they might have on issuance volume. You know, what structures are you currently employing to address, you know, compliance with the rules, and how do you anticipate, you know, whether it's the platforms or Rosemary, you know, how do you anticipate the current solutions evolving?
Yeah, risk retention's probably been the number one focus for us over the course of 2017 as it relates to the structure of our transactions and how we're solving for them. The first deal, for example, we probably spent 30% of our time trying to figure out, okay, how are we going to do this? So Marlette's choice on that front has been vertical risk retention. That's partly necessitated by the fact that we are a hybrid model where we sell some loans and we retain some loans. We are a multi-seller program in the sense that our whole loan buyers are coming back to Marlette and we are securitizing alongside them. So our balance sheet, Cross River Bank's balance sheet, Cross River Bank's the originating bank for Marlette, and our whole loan buyers are all alongside each other. And horizontal risk retention in that environment to us is very complicated. Not sure the technology exists at the moment, or rather the sophistication all around to facilitate that. And it's also messy from an accounting perspective. So our risk retention solutions have been focused on, okay, how do we get the most efficiency out of vertical retention? And we've set up majority-owned affiliates for all of our transactions. And we're now in the process of actually moving assets around between those majority-owned affiliates. So I think it's still at the second inning here. There's a lot that could happen. The risk retention is a pretty big chunk of our balance sheet. And if you do the math, if someone's doing $1 billion of securitization a year, or $2 billion, or whatever the number might be, $50, $75 million of risk retention, it starts to add up over the course of a year or two. And so I think that there'll probably be fund structures or other kind of mechanisms by which people are starting to participate in the risk retention, either as leverage providers or as actual risk bearers. And possibly we'll start to see some of the CLO technology. Well, we'll see if CLO is going to develop any more technology on this front. But some of the existing CLO technology and the manager programs you have there come into the space as well.
Great. You know, although we're more than 2 years past the Second Circuit's decision in Madden versus Midland, there certainly remains some noise in the market around usury and bank partner models and how to treat loans that may be affected by disparate geographical rulings. You know, maybe I'd start with Sid, but how have you thought about navigating these challenges and, you know, open it up to all the panelists? But do you think there's we saw the bill in the House a few weeks ago. Do you think there's a legislative or judicial or, you know, any other clarity on the horizon? Yeah,
sure. So you know, we think the Second Circuit probably got that decision wrong. We heard the same from the OCC, from the Solicitor General, and now the House has clearly moved in the direction of fixing that. We look forward to the Senate moving forward on that bill and eventually providing additional clarity to the industry as a whole. For 100 years, the industry operated under a certain model till that decision sort of created a bunch of confusion. So we look for that to get resolved. We're fairly optimistic given that the Senate Sponsorship is bipartisan. We have two senators from both the Republican and the Democratic side sponsoring the bill, so we consider that to be a positive. But if I look at just our structure as a whole, our structure, our relationship with WebBank, as the originating bank, WebBank retains an economic interest in the loans over the life of the loan. They do not get the majority of the revenue up front. They get the majority of the revenue over the life of the loan. And we look at the structure as one that is, that the Madden decision does not impact. However, clearly from an investor standpoint, there has been confusion, and certain investors would rather stay away from it. And so we worked with investors. There are many investors who are willing to take on the risk because they've done their diligence, they've got the legal opinion, they're willing to take on the Madden Midland loans. The others who aren't. But I think for the sake of the industry, I'm looking forward to more legislative clarity there.
Yeah, I think in the securitizations, what we've seen is for loans in the Madden states, there have been limits in terms of those loans above the usury rates. So I think generally 10% has been sort of what we've seen in terms of the amount above those limits, and there have been legal opinions. So I think there's been a lot of discussion over the past couple of years with respect to that decision, and the law firms are comfortable providing opinions in that, and I think that we also look forward to seeing more clarity around that.
Yeah, I just add that we're all hoping that Washington will fix the problem, but if they don't, then there's certainly, I don't know if it's an expectation, but some sort of hope that the states will also realize this is net negative to the consumer. And it's not really serving everybody knows it's not really serving the purpose it was supposed to. So potentially hopefully we'll see some sort of realization on that, and that'll give investors more comfort. But until that happens, there are also structural solutions on the structured finance side where, as I mentioned, there are some investors who are comfortable taking the risk. So instead of passing through all the risk in broadly syndicated securitizations, we could separate the risk out into separate transactions that only involve those perceived riskier pools that are marketed to investors who understand the credit and understand the risk and are willing to buy it. So instead of separating risk by tranching, you're actually separating risk pools out completely. And Goldman, for example, is innovative in areas like this, and I think that we're all putting our heads together to try and find a solution, because these are customers who need to be served, and by not having a financing solution on the back end, they're not going to get served.
I think that's a critical part of the equation is when we speak to the regulators, and we're talking to all the regulatory bodies fairly often, we hear sort of a general acceptance of the fact that the product is a more responsible way for a consumer to borrow, as well as, in general, the asset class, the creation of tech-enabled lending has been a net positive from a financial inclusion standpoint. The Philly Fed wrote a paper about it last year, which was very clear about that. What we're seeing is whether it's the idea of a fintech charter, whether it's general support from the Federal Reserve, Chairman Powell made very positive sort of comments around supporting sort of the idea of fintech being positive for the end consumer. So as long as sort of people realize that fact, then if you think about the states that are impacted by the Madden decision, we've got to find a way of solving for ensuring that the product is provided to the consumers in those states rather than just backing out of those states altogether.
Great. We've certainly seen some platforms have divergent fortunes over the past year, ranging everything from successful capital raises to strategic partnerships or sales, to in some cases termination of operations. Maybe open up the question broadly to the panel, but what do you see as some of the key factors or best-in-class practices separating the winners in the market?
We've certainly had some counterparties that are no longer up and running, and that's been not fun to deal with, servicing transfers and so forth, and keeping the data updated because people still own the assets. But I would say, I'd say that the first fork in the road is kind of what's the business model, right? Are you really kind of a bigger consumer lending brand, like the platforms on this table, or really just a specialty finance company. And I think that's kind of the first fork. And then if you are kind of a bigger consumer-facing brand, then you really have to have diversified business. And we've already discussed that with all the different things going on, so that if any one of these channels dries up a little bit, there's definitely more liquidity out there. That's not to say at the end of the day, all these things aren't highly correlated with each other, but again, there's just certain hiccups, and there's, where there were some problems before, some of these platforms just didn't have any backup plans, and they were really dependent on one or two investors, and then if those guys walked, then it was game over. So I think that diversification is key, and also just understanding what you're really trying to accomplish. And now I would say we're not seeing, with some of the new platforms that come about, they're not trying to be lending club. They're trying to be this specialty finance company that's addressing this very special niche and making it way more efficient with technology, and then funded by a couple of investors, or have warehouse lines with some of the major banks, but again, still some diversification within that mix.
Yeah, and I would just say that overall we've seen a shift in terms of the focus on, when we say fintech, we say, is it a capital F or a capital T, right? So initially, we saw a lot of, folks that were more, tech related. I think that's obviously beneficial in terms of potential equity, valuations. But what we want to see in terms of the lending markets and in terms of credit is people focusing on the lending standards and looking at it in terms of, we want grown-ups in the room in terms of looking at, being able to make the decisions they need to make to pull back when needed, to ensure that there are, the appropriate controls and discipline in place, and focusing on the diversification of investors. And I think that's been a very big focus of this segment over the past couple of years, which we have viewed as a big positive for, many of the folks that or the people that we rate in terms of the transactions. So I think that it goes back to when we start looking at someone, the business model, what are they doing, who are they, who's the management team, what's their experience, and how are they going to manage this for the long term. And we look at all of those in combination to get comfortable.
I forgot the most basic thing, which is performance. If the loans don't perform, no one's going to
have a reason to exist.
So.
Yeah. So I think the winners and the losers are separated by three things. One is their ability to manage credit risk, their ability to manage liquidity risk, and then scale. The credit risk is obvious. If you can't originate loans that perform, you're going to pay for it one way or the other. Liquidity risk is critical. We look to constantly diversify sources of capital for us. We have retail investors, we have banks, we have hedge funds, we have large asset managers, we have insurance money, and as the space continues to evolve, the kinds of investors that participate on the platform continue to grow. And what we've seen is a couple of different occasions as the markets, whether spreads widened, the beginning of 2016, certain investors pulled back, but others stepped in. When we had a hiccup in May 2016, other investors pulled back, but a different set stepped in. The more diversified you are from a liquidity standpoint, the likelihood of managing through stressful periods, you have a better shot at it. And then the last piece around scale. I think scale brings a number of benefits. One is larger, diversified, sticky, strategic pools of capital want to participate only if they can participate at scale. They don't want to participate if they can get only 5 or 10 million a year. They want to participate if they can get $1 billion a year. So scale is critical from the standpoint of attracting the right kind of capital to the platform. But on a consumer-facing basis, if you don't have scale, you can't establish a brand. And it's the same thing in the banking industry. While there are 5,000 banks, there are probably 8 or 10 banks that dominate the space because they have the scale to be able to brand themselves nationally and therefore be able to deliver multiple products to the consumer. It's the same with the tech sector. As we do more online lending, for platforms to evolve from single product to multi-product, they have to be able to establish a consumer brand, and scale is critical to that.
To take your funding point one step further, one thing that could really help a platform is a stable stable, long-term, low-cost source of funding like a deposit base at a bank. And we think that a synergistic partnership between a bank and a platform helps both, because there is low-cost funding on one side, and there's a new customer acquisition channel and tech on the other side. And the scale, like Sid talked about, that leads to customer acquisition right away for a bank to shore up its ROE from basically nothing to double digits, and the synergy between the funding for the platform, which they don't currently have.
Yeah.
Sorry, go.
Sorry.
By all means.
At Marlette, we've had singular credit focus since inception. That's probably one of our hallmarks and has yielded, class-leading returns. We have a very short feedback loop internally in terms of how we react to the credit environment. And that's good DNA, but that's also DNA we need to now extend with customer focus. There's a lot that we need to do to recognize who this customer is, the customer that we in the tech-enabled sector are serving today. This is what we think customers are going to look like 20 years from now, which is why you're seeing the bigger banks. Marcus gets mentioned in every conversation, so we might as well bring it up again. Marcus, the city announcement, that this is validation for the sector. And this is how we think everyone's going to do business in the future. So we're setting the template for ourselves, to some extent still figuring it out, and trying to make sure that we can build businesses for the long term.
Great. I think we made the point about getting core credit right and how critical that is, but maybe talk about what you see as the biggest challenges, whether funding, regulatory, et cetera, for the sector for the next, call it 12 to 18 months.
I think it's going to be credit, quite frankly. I mean, just from our seat, there's no shortage of funding. The regulatory environment is the winds are blowing in a better direction than they were a year ago. But I think the thing that we encounter a lot with investors is still some hesitations just around performance and really understanding what's been driving performance. I think, Sid, what you talked about with how you guys are looking at it, and I think the platforms are doing a good job of communicating it, but just getting people comfortable with that and also comfortable with how things might evolve if the credit environment becomes a little bit more dangerous.
Yeah, I agree with that. I think that, with the increase in competition, not only with the, larger banks getting into the segment, but also there are some new players that are, rapidly, coming on in terms of growth. And so I think that, we've seen through 2015 and 16, there were certain segments where there were, some weaknesses in terms of delinquencies and somewhat higher losses. But, to the positive that we've seen, the folks, like, Sid and Karan and their, platforms pulling back on segments where they weren't happy with that performance. And I think that's going to be even more important going forward, that they're focusing on specific segments and looking at it in terms of what does it mean for those obligors and for those loans in terms of, overall the consumer credit environment is still good, but you have to look down to the specific, areas that they're lending and look at where is there more competition and what does that mean going forward for the space.
Great. Maybe before we open it up to a couple of audience questions, I'll just ask each of the panelists to take a look into their crystal ball and give us a volume prediction for 2018. Can just be directional, and then their best guess. We'll leave the Fed speak aside, but for credit spreads at year end versus where we are on the spot basis.
Up and tighter.
Yeah, I can't disagree. I think I won't put a number out there in terms of volume because I guarantee you whatever number I put out there will be wrong. The volume is going to grow. Securitization volume is going to grow. The asset class itself will grow as more and more consumers become aware of personal loans relative to credit card being an option to manage their sort of debt needs. Volume for the industry will grow and as a knock-on, securitization volume grows. In terms of spreads, I think we've talked about this a bit. I think just given relative duration yield trade-offs, I think this still remains fairly attractive at today's spread. So, I look to the market to remain fairly strong this year.
Yeah, I agree. I think we're definitely going to see more volume, and part of it relates to the fact that Lending Club as well as Prosper were just really getting their sponsored securitization programs up and running last year. So right there, you would expect to see more volume in terms of ongoing issuance, but there also may be some other players in the space. In terms of spreads, I would say that, what we talked about here in terms of investors getting more comfortable over time, I think that's, we've seen that being very important over the past year of, tightening those spreads. And I think, as we continue to see more performance data in the space and be able to demonstrate that performance, I think that's going to be important for even more investors to come into the segment. So I agree in terms of the very short answer that Perry gave in terms of the tightening on the spreads.
Since I already threw a number out there, I would say we're thinking 18 billion for the year, so 50 billion, around 50 billion total. I'm sure it'll be blown out of the water. In terms of spread, there is still a decent yield pickup over similar duration securities. So you should see compression, I would say about 10 odd basis points on the seniors, maybe 20, 30 on the junior subordinates.
For volume predictions, I think modest growth. For securitization volume, I think fairly significant growth. For spread compression, I think spreads will compress 10 to 20%, but I think overall yields will potentially start to rise. And cost of funds could start coming under some stress.
And when do the IOPOs come into the world, into the mix? Can we get a date on that?
It's next year's panel. Okay, so it seems like a fairly optimistic view of both direction of the market and kind of availability of product. We've got a couple minutes left, and maybe open it up to any questions for the panelists from the audience.
I have a question. Is the borrower's demographic measurably different between the consumer in this segment compared to overall consumer classes?
We haven't seen it. Rosemary and others, I'd love to get your point of view. When we look at our platform, in the early days, so we've been around 10 years. In the first 2 or 3 years, there was definitely an early adopter bias. But now it's pretty mainstream. I mean, the average age of the borrower is 40, in the mid-40s. You look at the income range. For people who apply, it's fairly broad. For the ones who get issued, it depends, but the average income is just above the U.S. median household income. So, it's a fairly representative demographic. There are some platforms that have their stated segment, which itself is sort of a high net worth, but for platforms like ours, which are broad mass market appeal, it's representative of the U.S. creditworthy demographic.
Yeah, I agree. I mean, there's a couple of interesting things there. One is, just you have to look at each platform in terms of what their focus is on the credit segment in terms of, SoFi, being, higher in terms of that credit segment. You may, they're targeting more, Henrys in terms of those high earners, not yet rich. And then, looking at someone like Avant, where it's a little bit more subprime in nature. But then the interesting thing, I think, is that, to Sid's point, you would expect, when you talk about it up front, that it would be more, millennials, and you expect it to be, more young folks, just in terms of that target. But it really, ends up being more of, maybe not people quite as old as me, but, an older segment that actually are taking the loans for across the platforms. So I think that's an interesting point. And some of it goes to how the loans are being marketed and originated. So, there still is a fair amount of direct mail, actually, to consumers, so they're able to target the consumers that they want to have in terms of, offering loans on the platforms.
Yeah, it's interesting. Different ways of reaching the consumer, but when the consumer comes to us, the majority of them come through a mobile phone. So interestingly, just the continued adoption of smartphones. At this point in time, I think the U.S. market is pretty well penetrated by smartphones. The consumers more and more are doing everything on their phones. And as the bulk of the demographic adopts smartphones as a way of doing their banking as well as other activity, you're going to see that shift continue to be more and more representative. There are pockets of people who today still prefer to walk into a bank, but that's becoming fewer and fewer.
Time maybe for one more. Okay. Well, with that, I will thank you all for attending and thank our panelists for their insights.
Thank you.